Hey guys, how is everyone doing? This is Nick from forexnoobs.com, and today we are going to be doing a webinar. This is the first webinar in a 2-day series. So we're going to talk about the first half of stuff today and the second half tomorrow. This isn't just one, this is two. So after this webinar, you might be thinking, well, I learned some good stuff, but I want to learn more. Don't worry, tomorrow at the same time, there's another webinar from New Jersey. Nice. I say nice because I'm a big fan of mob movies, and a lot of them are based in New Jersey. I guess it's the Italian in me. Stansted. I visit Stansted a lot, but I never actually stay in Stansted. Literally just to catch planes. Northwest, people from everywhere. Michigan, Northwest London, South Africa, Cambodia, India, London. Yeah, Stansted looks pretty cool, but all those planes flying overhead, I know you get used to it with time, but Newcastle, awesome. I grew up in Australia, for those of you who don't know. Sydney. But I've been to Newcastle heaps of times. Oh, Amy. I'm from Sheffield too. Sheffield's awesome. Sheffield gets a bad rap, but it really is the best city, or one of the best cities. Living in the Peak District is just awesome. Endless places to go running and to hike and all that. Anyway, look, guys, we're not here to talk about where we live or all that kind of stuff. We're here to talk about my price action strategy. So let's get started. Okay, so what are we going to be discussing today? We're going to be looking at my price action strategy. Look, trading is tough. It's stressful. It's complicated. And it can be pretty overwhelming, really, because of everything you need to think about. And also, look, I'm sure you guys know that a lot of traders, and you're probably one of these traders, most of you here, not all of you, but most of you probably struggle with consistency in your trading. And why do you struggle with consistency? Because the Forex market's always changing. The Forex market's not the same now as it was 6 months ago. There's phases that it goes through, low volatility, high volatility, all kinds of changes. And most strategies don't really adapt well with those changes. You need to change the strategy itself. And that in itself can actually be quite overwhelming. But with price action, it takes a lot of the overwhelming stuff away, because price action adapts to changing markets without you having to actually do anything. It just adapts because what you're reading is price. And when the market changes, price is moving differently. You're still reading that price and making decisions based on price action. So your strategy just naturally adapts to changing market conditions. And that's why I trade price action. That's why I think price action is really good. So, over the next 2 days, we're going to be looking at my price action strategy. So what are you going to be learning? Well, first, we're going to start with my simple and flexible trading strategy. We're going to be looking at, essentially, because it's a price action strategy, it's indicator free. So there are no indicators. We're going to be looking at indicator free trading. Indicator free trading. Pretty important. Because you know how I said trading can be overwhelming? Well, when you don't have indicators, it takes a lot of that overwhelming stuff away because there's less to look at and less to think about. We're going to be looking at low maintenance trading. Low maintenance trading basically means you don't have to invest much time to get a return. Now, when I say that to people, they're like, yeah, right, that makes no sense, too good to be true. And obviously, there is an aspect of that that's too good to be true, because the less time you spend trading, the less trades you're going to take, the less profit you're going to make. So low maintenance trading is something you can do, but you have to accept the less time you spend trading, the less profit you're going to make, because the less trades you're going to take. So you can't have it both ways. You can't have great returns with almost no effort. That's just, it's impossible. We have to be realistic here. You can take a low maintenance approach to trading using this strategy if you want to. You can also spend a lot of time trading this strategy and get more trades. If you take the low maintenance route, you have to accept that you are going to get lower returns because you're going to be taking less trades. But you can go the complete opposite way and take a lot of trades and make more return. Or you can take the middle road, which is generally speaking what I do, and, trade somewhat frequently, so like a few hours a day, let's say, and make a decent return. But it's up to you. I'm going to be showing you how to low maintenance trade. So if you want to do low maintenance, do low maintenance. If you want to do high maintenance, then go crazy and take lots of trades. If you want to do middle of the road, then you could do middle of the road. It's all about being flexible. It's a flexible trading strategy, isn't it? So, how to spot powerful trade setups, we're going to be looking at that. That's probably going to be in day 2. Maybe we'll get into that a bit in day 1 today. How to set smart targets and stop losses. I mean, I can give you the best trading strategy on the planet that has a 90% win rate. But if you don't know where to set your targets and your stop losses, you're probably not going to make any profit anyway. Because knowing where to enter trades is only half the battle. Knowing where to place your target, the right place to put your target, and the right place to put your stop loss is essential. Because if your target is wrong, it might never get hit. Or it might take you out of a trade that could have made you a whole lot more profit. If your stop loss is wrong, it might take you out of a trade only for that trade to turn around and go in the direction you were predicting anyway. Or your stop loss could be so wide that it costs you a lot more money when it gets hit than it should do. So we're going to be looking at smart targets and stop losses. That's going to be tomorrow in day 2, and we're going to be looking at, if we have time tomorrow, how to exit trades at the right time. Now, this is another important factor, because with trading, I mean, you set a target before you enter the trade. That's how traders do it. If you don't do that, you're not doing it right. Set a target before you enter the trade, but that target can change throughout the trade. If the trade's not going well, there's some factors that might make you decide to tighten that target or to exit early. If the trade's going really well, there's a lot of momentum, there's some factors that might make you decide to extend that target. So we're going to be looking at that, how to extend targets, how to do all that. So let's just go over some of the rules real quick. First of all, we're going to be doing questions and answers at the end of this webinar. Please do not ask questions during the webinar because, well, I'm just not going to answer them. The problem is, if I start answering questions during the webinar, we're just going to get thrown off track. It's going to be annoying for everyone. I've done it before, so I'm just going to ignore questions. When you do ask questions, please keep them on subject. Don't ask, how do you enter this trade? Because we're not talking about that today. Today we're covering the basics. Tomorrow we're going to jump into how to enter trades. So leave those questions for tomorrow. Today, keep your questions on subject, basically, on point, related to what we're going through today. And the third rule, be kind and respectful. If you're not, the moderator, George, he's just gonna ban you, just like delete you. I don't know if he can kick you out, but he'll just like delete you from the chat, so you can't type anything. if you have a problem with something I say, if you disagree with something I say, that's fine. I don't mind. I don't mind talking to people who disagree with something I say. I don't mind talking to people who say that I'm full of crap. I don't want to say the other words, so I'll just say full of crap. I don't mind talking to people who say that because I like discussing these things, but just do it in a nice way. You don't have to be rude about it. Approach it nicely. Otherwise, yeah, you'll just be muted. Anyway, so those are the rules, guys. Before we jump into the content, I just wanted to tell you guys a little bit about me, a little bit about myself, who I am. Now, I know a lot of you don't care, but there's a lot of people who do care, and I always get questions about who I am and blah, blah, and then I end up answering them later. It takes a lot more time. So I figured I'm just going to add 10 minutes to this webinar and go through it now. Just give you a quick background on me, and we'll get that out of the way. That way those questions are answered. So my name's Nick Bencino. I've been trading since I was 15 years old. I started trading at 15 because back in Australia, a lot of you Aussies might know this if you went to school in the late 90s, early 2000s. Back in Australia, if you did economics or commerce, it was called commerce, the class, in school, we had this thing called the stock market game. Basically, the stock market game was this demo trading competition. Every student in the class got a demo account with, I think it was 50,000 Aussie dollars or something like that. I can't remember exactly. And we were told, trade this, whoever makes the most money wins. It was demo money, of course. So you weren't making any real money, but whoever made the biggest return won. Now, most of the students in the class didn't really care and they weren't bothered. But I was really into it. I really wanted to take this demo account and make a lot of money with it. Now, the reason I wanted to do that is because I'd watched Wall Street a few weeks before. You know, the Charlie Sheen movie with, I can never remember, Michael Douglas, Martin Gecko. I watched that movie, so I was like, whoa, being a trader is so cool. I want to make this thing work. So I just jumped straight into this competition and I did my best. I started buying financial newspapers, all that kind of stuff. I really, really got into trading. Now, I ended up winning the competition. I did really, really well in the competition. Now, you know, I would love to say it was some kind of natural trading ability, but it wasn't. It wasn't natural trading ability. I just got lucky. I was kind of gambling, really. I wasn't really using any proper strategy. But anyway, I ended up winning the competition, and that's what started my trading career. After that, I got a trading account. My last 2 years of school were basically spent trading. I wasn't really doing anything other than trading. And I made a bunch of money. I made a lot of money when I was really young trading. But this is not me bragging because I wasn't doing things right. I was essentially gambling. I wasn't using risk management. I was just taking trades and they were going in my direction. And anyone can do that. I was taking massive risks. And that's why I was making massive returns. But eventually that catches up to you. And I ended up losing all that money. Literally losing everything. Going down to zero. Margin call. So basically, I gave up trading for about roughly a year. Look, I don't want to bore you guys with the story. Basically, the thing is, I got back into trading a year later. I started slow. I started trading smart. I took a better approach. And over the next year and a half or so, I taught myself trading. So by that point, I was 19. I've been trading since I was 15. I'm 32 now. Been trading 17 years, almost 18 years. This is pretty much all I've done with my life, trading. And this strategy that I'm about to teach you, I developed this strategy myself through observation, looking at the charts, taking trades, messing around. It's the same strategy I've been using since I was 18 or 19. It's just evolved a lot. It's changed a lot. It's been refined a lot, but it is essentially the same strategy. It's price action, it's simple, it's clean, it's flexible. And that's what we're going to be looking at today. So hopefully that answers all the questions people have about me. Let's get into it, guys. Let's get into the actual content. Oh, yeah. So what is price action? Price action is essentially the movement of price. When you look at a Forex chart, or any chart really, what do you see? You see price moving up, you see price moving down, you see trends, you see price moving sideways. Price action is the movement of price. That's what it is. The market moves up and down based on who has more power at the moment, bulls or bears. When bulls have more power, price moves up. When bears have more power, price moves down. So price action is the analysis of the movement of price. And when I say bulls and bears push price down, who are the bulls and the bears? Are they us? Retail traders? No. No. We don't really have that much of an impact on the market. I know a lot of people like to think retail traders do, but truth is retail traders don't. Retail traders less than 10%. I think it might be less than 5%. I can't remember exactly. But we have a very little impact on the market. Who has an impact on the market? The big banks, the managed funds, the hedge funds, the people trading billions. They are the ones that have an impact on the market. They are the market movers. So price action, bulls and bears, they are essentially the big banks, the managed funds, the hedge funds. They are who is moving price. Now, price action analysis allows us to analyze what they are doing and trade along with them. So by reading price action, we see what the big banks, the hedge funds, what the market movers, the big boy traders, that's what they're called, the big boy traders. It allows us to see what the big boy traders are doing and trade along with them. Because what they do has an impact on the chart. They're the ones moving price. So what they do has an impact. And once you learn to read that impact, you can predict with a high degree of accuracy what's going to happen next. And that is price action analysis. That's what we're going to be looking at. And in order to do that, all we need is this. This is all we need. We need these blue areas here. These blue areas are called support resistance areas. And we need these things here, candlesticks. We don't need fancy indicators. We don't need any of that stuff. We just need support resistance areas and candlesticks. I'm not saying that indicators are useless. Indicators can be used. I'm just saying personally, I don't use indicators. I don't find them that useful. And I use just pure price action. So that's what I'm going to be teaching you guys. I'm going to be teaching you guys how to trade with support resistance and candlestick analysis. You guys excited? There's a bit of a delay in the YouTube thing. So when I say, you guys excited? It's like 10, 15 seconds later that you guys can actually hear it. So it gets like a little awkward. Are they going to say they're excited? It's taking them a bit long to say it. Anyway. Where were we? Oh yeah. Going to get into we're going to start things off with support resistance areas. Support resistance areas are very, very simple to place. They're very easy to place. You place them manually. I know that sounds daunting, but they're so easy to place. A lot of people just make them a lot harder than they need to be. Support resistance areas, dead simple. So we're going to kick things off with support resistance areas. I'm going to show you how to place support resistance areas. Then we're going to take a look at candlestick analysis. If we have time, we're going to take a look at some basic trade setups, but I don't know if we'll have time for that. So let's get into it. Placing support resistance areas. There are 3 simple rules to placing support resistance areas. These rules might not make sense to you right now, but we're going to switch over to a live chart in a minute, and then they'll make sense to you. So first rule is body congestion wicks. Body congestion's wicks. That is the order of importance for your candles when you're placing support resistance areas. The candle's body, congestion of candles, and wicks. BCW. BCW. Remember that. When you're placing support resistance areas, BCW. Again, if this makes no sense to you, don't worry. We're going to switch to a chart and I'll explain this rule on the actual chart. Number two, recent data is more important. When you're placing support resistance areas, you're placing them based on bounces, big bounces. The more recent the bounce, the more important. The more recent the bounce, the more important. If you got a big bounce from 2017 and then another big bounce that's slightly higher or slightly lower from 2018, the 2018 one is more important because that's more recent. Number three is to place them quick. Might sound counterintuitive, but this is the most important rule in placing support resistance. Place them quick. Why do we place them quick? Support and resistance areas work because they're used by big banks, hedge funds, the big boy traders. They're using support resistance. So they work because they're used by the big boy traders and because they're used by a lot of them. So the support resistance areas that work, they are usually the most obvious standout ones because those are the ones that most people are looking at. So if you spend an hour on each chart trying to place the perfect support resistance area, you start to see things that aren't there. You start to connect dots that aren't really there or that are barely there. You end up with a lot of support resistance on your chart. You end up with a lot of minor ones and they become useless because there's too many of them. You want to place the most obvious ones, the ones that stand out. When you look at your chart and you see a standout area, just like so obvious, those are the ones you want to place. And the easiest way to place them is to place them quick. Because if you place them quick, you're only going to place the standout ones. You're not going to look too deeply and try to find things that aren't there. Anyway. Oops. I am going to switch to a live chart. Giovanni questions at the end, but it is a kind of decent question, so I'll quickly answer it now. You're thinking of hedge funds as if they're a single entity who is making decisions, but that's not how it works. There's tens of thousands of banks, hedge funds, and managed funds. A single one of them can't really affect the market. It's all of them together that are affecting the market. So that's why support resistance works, because the tens of thousands of, or even hundreds of thousands of different traders working for all these hedge funds, managed funds, banks, they're all looking at support resistance areas. They're not all calling each other saying, hey guys, let's go short and influence the market. Well, I mean, there have actually been cases of that. Not so much in Forex and stocks a lot, but there has been a few cases of that in Forex, market manipulation. It's very rare in Forex, but it has happened. But overall, you got like, we're talking about hundreds of thousands of traders here. We're not talking about a single institution that's affecting the whole market. So that's why support resistance works, because it's a bunch of different people looking at the same thing. And no single person has enough power to actually have an influence on the market. Make sense? Cool. Well, you haven't said it makes sense, but I'm assuming it does. And even if it doesn't, questions at the end. We can revisit in more detail at the end. Anyway, so let's get into placing support resistance areas. The first thing you do when you're placing support resistance areas is you zoom out a little bit to about 1 year or 2 years of data. Now, what does 2 years of data look like? Roughly like this, something like this. So this is about 1 year. You want to look at about 1 to 2 years worth of data. That's what you're looking for. Now, this isn't a set in stone rule. It doesn't have to be exactly a year. I don't adjust these candles until I have exactly 1 year of data. 1 to 2 years, just a rough kind of idea of how much data you need. Roughly 1 to 2 years. So this is December 2017, so it's just over a year worth of data. No, just under a year. Yeah, what am I talking about? Just under a year. So this is enough. There's plenty of data for us to place support resistance areas on. So, and this is a daily chart, by the way. You have to switch to the daily chart. Daily chart's important. You don't want to place support resistance areas on other charts. You place them on the daily and then you use them for all the time frames. So first thing you do is you place the topmost and the bottommost. So this is the topmost. Why is this the topmost support resistance area? Because this is the biggest bounce from the top. Where's the bottommost? There. Now with support resistance areas, I like to look for two bounces, two connected bounces with each support resistance area. The only exception to that is when you're placing the topmost and the bottommost. The topmost and the bottommost, because they're usually huge bounces, I'm willing to accept a single bounce. So that's a single bounce there, that's a single bounce there. Topmost, bottommost, I'm willing to accept single bounces. Okay, now, after you've done that, all you want to do is fill up the areas in between. Now, I know a lot of you are thinking already, how wide do you set these shaded areas here? Those shaded areas don't actually mean anything. The shading doesn't mean anything. I just have the shaded area there because I think it looks better and I like it. A lot of people just use flat lines or horizontal lines. And you could just use horizontal lines if you want to. The actual width of the area doesn't mean anything. I just like the blue shaded areas. I think they look better. So yeah, you place the topmost, you place the bottommost, and then you fill up the areas in between. So how do you fill up the areas in between? Well, you look for price bouncing from the same area. So you're connecting dots. So what do I mean by connecting dots? Well, this bounce here, that's a dot. That bounce there, that's a dot. These dots kind of line up. So, did you ever play connect the dots when you were a kid? Well, not play, but you know those coloring in books where it has like a dot with a number and you just kind of draw lines in between them and you end up drawing this picture and then you color it in? That's how you play support resistance. Connect the dot. Dot here, dot there. Let's connect them with a line. Boom, done. Easy. Simple stuff. This is how I play support resistance areas. I'm placing the most obvious ones. That's how I do it. I place the most obvious ones. I connect the dots. Now, a lot of people try to make this more complex than it actually needs to be. Connecting the dots here. So, bounce there, and congestion here. Remember how I said body congestion wick? Body congestion wick. What is congestion? Congestion is when price moves sideways on top of a support resistance area. So price is moving sideways there on top of that support resistance area. That is congestion. Body congestion wick. That's what's important in trading. In placing support resistance. The body of the candle, the congestion, and the wick of the candle. I'm actually going to move this one up a bit. Recent data is more important. Remember that? Recent data is more important. This is where the most recent bounce is. Now, when we place support resistance areas, we place them at the bodies of the candles, not the wicks. If we were placing them at the wicks of the candles, they'd be up here. See, the center line would be at the top, at the wick of the candle. Now, I prioritize bodies over wicks. Bodies are more important than wicks to me. The reason for that is that that's where price stalls. It doesn't usually stall at the wicks, it stalls at the bodies. That's where price gets stuck at the bodies. The wicks are just the extremes. So we place them at the bodies first. So remember body, congestion, wick, bodies, then you look for congestion, places where price kind of moves sideways and gets stuck, and then you look for wicks. So we're prioritizing bodies over wicks. This is so wide. I'm going to place one there. Why am I placing one there? That lowest one is really low. See how I place this lowest one based on that bounce? I think I'm just going to delete that one. The reason I'm deleting it is because we don't need it. I mean, price is all the way up here. If it moves all the way down here in the coming weeks, then sure, we can place an area there. But right now, I like to keep my charts clean. I don't like having too many support resistance areas on there. So I'm just going to get rid of that one. That one's not that important. Place one at this recent bounce here that we got earlier this week. And we're going to go back a little bit, back in time, because we don't have any recent data, and place one there based on these free bounces here. So see what I'm doing? I'm just placing them based on the most recent data, placing them on the bodies, prioritizing the bodies, and I'm placing them quick. I'm not putting too much thought into where these are going. Because once you start putting too much thought into it, then you start adjusting them and then moving them around and trying to get them perfect. And support resistance is about what's most obvious. The more obvious the area, the more likely it's going to work. So we want to place the obvious ones. So there you go. We have support resistance areas for USD CAD. Very simple, very straightforward. Now, let's do New Zealand USD. I want to do New Zealand USD because New Zealand USD is a little different. Remember how I said, switch the daily chart, place the topmost and the bottommost? So you place the highest and the lowest? Well, in this case, price is trending down. Price has just made a new low, so we can't really place a bottommost. We can scroll out to around about a year worth of data, roughly. We can place a topmost one based on this big bounce at the top here, because that is a massive bounce. So we can place a top one there, but where do we place the bottom one? Where do we place the bottommost one? We can't really place it because prices, there's no big bounce from the bottom, but that's fine. I mean, if you can't place a bottommost one, that's fine. Just place the topmost, do what you can, and then start filling up the areas in between. Well, sorry, there is no area in between. But the thing is, why do we need this area up here? Price is all the way down here right now. So why do we even need that area? Price isn't going to hit this area for a long time. Unless we get some insane, crazy moves that takes price up there in the next few weeks. It's probably not going to happen for several months, even a year. So we don't really need that one up there. So I'm going to place it here instead. That's a pretty big bounce there. I'm going to place a support resistance area there. That's closer to what we need. And now we need some for the bottom here because price is moving down to this area right now. We need some for the bottom there. So we're going to scroll back to, looks like 2016. Now you can go back in time to place your support resistance areas. I don't like going back too far, but sometimes you have to. You know, sometimes you just have to. That's just the reality of trading. Sometimes you have to go back to place your support resistance areas. So we've gone back to 2016. We've got one body bounce and one wick bounce here. So those two bounces, that's good enough to place support resistance areas. We got a very big bounce there, very big bounce. So I'm happy to go with a single bounce, but there are also, this isn't a single bounce actually, because if you look here, we can also see bounces from there, free there, and a big one here. Is that low enough to, yeah, that's low enough, cool. Yeah, that's fine. Keep it there. See, price is moving down to this support area right now. So next week, when the market opens, I'm going to be looking for price to stall at this support area and potentially turn around. but we'll get into that later. All right, so we got one at the top, we got one on the bottom. Let's just finish filling up this area in between here. Should be pretty straightforward. Again, we're just going to play a game of connect the dots. Connecting the dots is pretty straightforward and easy. I'm going to place one here based on this bounce, but it also lines up with that bounce there. Doesn't have to be perfect, doesn't have to line up perfectly, but we got body bounces here, body bounces there, and we got a wick bounce here. See, that's a wick bounce there. Body congestion wick, the bodies are most important. Body bounces there, boom, done. Easy stuff again. Huh. Kind of. Yeah. These aren't that wide, but yeah, something like here. We got a body bounce there, and we got like a wick bounce. It didn't quite get right on top of the area, but it's close enough. A wick bounce there and a body bounce here. Yeah, that's it. Boom, we got support resistance areas for New Zealand USD. This is a fast process. I'm talking you guys through it, so this is taking a bit more time, but I can literally place these support resistance areas on each chart in under a minute. I've been doing it for so long, you shouldn't be able to do it in a minute right away. That takes some time to learn. But the point is, I'm placing the obvious ones. I'm placing the standout ones. I'm not placing I'm not spending too much time, because the more time you spend placing support resistance areas, the more likely you're going to place bad ones. The best support resistance areas are the obvious ones, the ones that stand out. So those are the ones you want to place. I mean, we could go through more support resistance areas, but we're already almost 40 minutes into this webinar, and we can do some Q&A on support resistance areas at the end. But I think most of you guys should get this, and if not, just rewatch it, because it's very, very simple to place support resistance areas. You just place them at bounces that line up. 2 or more bounces is preferable, but if it's a very big bounce, then 1 bounce is fine. And what are bounces? Bounces are essentially the big V shapes that you get on your charts. Huge V shapes. So hopefully that covers the support resistance section. Support resistance is important. I share my support resistance areas on the website, so you can copy mine until you learn to place them on your own. You can copy mine from the website. I'll send you guys a link to that later. Let's look at candlestick analysis. That's the second part of the strategy. Once you have the support resistance areas, you look at the candlestick analysis, because the candlestick analysis is what allows you to get into trades. So let's hop into candlestick analysis. Tomorrow we're going to look at putting these two things together to actually take trades. Right. So let's get into candlestick analysis. I do candlestick analysis different to what any other trader I've ever seen does candlestick analysis. I look at things differently because I taught myself how to do it. I didn't really learn it from books. I taught myself how to read candlestick analysis. So that's why I do it differently. Obviously, I'm biased, but I think my style is the best. But hey, it might not work for you. You might think, what the hell is this guy on about? But what I like to do is I like to think of candlesticks as a story. So I like to think of candlesticks as a story. So what is this? What is this thing here? It looks like just a line, but this isn't a line. This is a baby candlestick. This candlestick was just born. a few seconds ago, not even a few seconds ago, less than a second ago, this candlestick was just born. It hasn't moved up or down a single pip, or even a little bit of a pip. It hasn't moved up or down at all. It's just a brand new, fresh baby candlestick. Over this candlestick's life, it's going to be either bullish, bearish, or in some rare cases, it's going to be neither. Now, in this case, this baby candlestick grew up to be a bearish candle. That's its story. Its story was, it opened here. Over the course of its life, let's say it's a daily candle. Over the course of the day, it didn't move up a single pip. It has no wick. It just pushed down, 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 and closed here. That's the story of this candle's life. It lived for a day, started up here, closed down here, boom. Candle's life is over. Ended as a bearish candle, is bearish the whole time. That's how I look at candlesticks. Obviously, we're going to go a bit more in depth than this, but that's this candle's story. But knowing the story of one candle is not very useful. I mean, who cares if a single candle's bullish, a single candle's bearish? That's not really useful to us. Reading the story of price over a lot of different candles, over an entire chart, that's when reading the story of price gets kind of useful. So what happens when we see a lot of bearish candles? Like the candle we were just looking at, but we see a lot of them in a row. So each of individual candle in this trend is a bearish candle. That's its story. When you combine the story of a bunch of bearish candles together, what you get is a bearish trend. Over an extended period of time, this is a daily chart, so we got 1, 2, 3, 4, 5, 6, 7, 8, 9 days. For 9 days, price has been trending down on this chart. That is the story of price over all of these candles over 9 days. Now, before that, there was a bullish trend. So each individual candle in this trend, the story of these candles is buyers in control, bulls in control. Price opens, moves up. All these candles together for however many days this is, that forms a bullish trend. Now, sometimes prices, instead of trending up or trending down, it just kind of moves sideways like it does here. So when price moves sideways, what does that mean? Right? It means that neither bulls or bears can get control of price for a long time. You get bulls in control a little bit, bears regain control, and price just moves sideways. So that's the story for this period. However long this is like 3 weeks or whatever. No, more than 3 weeks, probably 6 weeks or something. For this 6 weeks, roughly, price has been moving sideways. Neither side can gain control. Neither bulls nor bears can gain control of price. This is what's called a range, essentially. It's what traders call a range. In a range, what you'll see is a lot of very small candles. Like these ones. See these small little candles? You see a lot of them in a range. Now in a range, these don't really mean much because what these essentially are, they're indecision candles. What's an indecision candle? It's exactly what it sounds like. It's a candle that's undecided. Neither bulls nor bears have control of price. When you look at this candle here, this big red candle, that is far from indecision. That is decision. That is, I am decidedly bearish. The bears are decidedly in control of price. This candle, the body is tiny, the wicks are up and down. This candle is the opposite. This candle is no one's really in control. During this candle's life, what's the story? Bears tried to take control. Bulls tried to take control. Neither side gained any significant control. But in a range, these candles don't mean much because a range is just price struggling to move up and down. Price moving around in a narrow corridor, let's say. So these candles don't really mean much. But when indecision forms in a trend, like here, that means a lot. That's very significant. Very, very significant. And that is the basis for most of the trades I take. Not only reversal trades, continuation trades, most of the trades I take. Not all of the trades. There's a few setups that we're not going to go through in these webinars that don't use indecision, but most setups use indecision, because indecision is a point at which you can usually enter a trade. So let's look at indecision in a trend. I'm going to break down the story for you because it's important to understand the story of price. Because when you look at price, what you need to ask yourself all the time is who is in control of price. Whenever you look at a chart, you need to ask yourself who is in control of price. It's a very, very important question. Who is in control of price? So reading the candle story allows you to assess who is in control of price. Look at this candle. Who is in control of price? The candle story tells us bulls are in control of price because it opened here, closed up there, bulls in control. Next candle, bulls, bulls, of course, bulls. So for these 1, 2, 3, 4, 5 candles, these 5 bullish candles, over these 5 daily candles, for 5 days, bulls were in control of price. That is what the story is telling us. Bulls are decidedly in control of price. But then what happens? Price hits this resistance area. What is a resistance area? A resistance area is an area where price stalls. It's an area where price bounces from. A resistance area is an area where there's sellers, where there's bears. That's what a resistance area is. So price went from being very bullish, from bulls being in control of price, moving up very strongly, hits a resistance area, an area where there's a lot of bears, and bam, what happens? It stalls. Look at this candle. What does this candle tell you? When you look at this candle in detail, we see a long upper wick. Price tried to push up, but failed and came back down. We see a small body because buyers couldn't close up there. We see a small lower wick. Sellers tried to push down, or bears tried to push down, but they couldn't get down. So this candle tells us price is undecided. Price has hit an area of resistance and it's no longer bullish, but it's not bearish either. We get another candle here. The next one. Next one, somewhat similar. Small bearish body, kind of decently sized upper wick. Very similar story to the other one. And then all of a sudden, the trend turns around. So what happened here? We went from a decidedly strong bullish market, price was completely bullish, to hitting resistance and price turning around. Now, this happens a lot on your chart. This happens a whole lot. It happens for continuations, it happens for reversals, and that is essentially what we're going to be looking at. We're going to be looking at continuations and reversals. So now let's switch back to a chart, and I'm going to show you some actual examples of trades, of potential trades. Now, the examples I'm going to show you are they're mostly trades that either I've taken or people on the forum, the Forex Mastermind forum, have taken. Most of these, I can't remember every single one of them because we're going to go back a little bit. I can't remember every single one of them, of course, but they're mostly trades that we've taken. I'm going to show you some failed trades, some positive trades, all that kind of stuff. And I'm going to explain this in a little bit more depth now that you understand the basic moving parts, how to place support or resistance. So what is resistance? What is support? Resistance is an area where there's sellers or where there's bears. When price hits resistance, bears enter the market and price turns around. Not always, but most, or well, not most, a lot of the times, let's say. What is support? Support is an area where there's bulls. When price hits support, bulls enter the market and turn price around. Support, resistance, support, resistance. Reading the candlesticks in conjunction with support and resistance allows us to enter some pretty awesome trade setups. Now, we're going to kick things off with this setup here. Right, so I'm going to highlight actually, let's zoom in a little bit. I'll use this tool to explain the basics of this setup. Right, so what happened here? This was a continuation. Now we're going to discuss continuations in depth tomorrow. I'll explain how to enter them, how to spot them. But essentially a continuation is when price continues in the direction of the overall trend. So if you look at New Zealand USD over the last, since April 2018, you can't deny that it's been trending down pretty heavily. It's been in a pretty significant downtrend. So a continuation is basically a continuation of that overall downtrend. To trade this continuation, what we would use is a combination of candlestick analysis and support resistance areas. So what do we have here? We have a bullish trend, bulls in control of price. So bulls push up to resistance. Price hits resistance, and what happens? We get indecision. We get indecision forming on top of that resistance area. Now, you might say, why is this resistance area here? But this resistance area is here because if you look here, there was bounces from there recently. So it makes another attempt at getting through that resistance area, its third attempt. And on its third attempt, what do you see on that resistance area? You see indecision. Price goes from being bullish, very, very bullish, very bullish. Look at that candle. That's a huge bullish candle. Buyers are in complete control of price. Hits this resistance area where price has bounced from before, and boom, you get indecision. You go from such a strong candle to buyers barely being able to make a new high, barely being able to push up at all. Then the next candle goes boom and shoots down. Then there was another candle here that shot up again. That happens sometimes, but overall, the downtrend continues and price moves down. So this is basically one of the trade setups that we're going to be looking at in depth. Not this setup specifically, but I mean continuation trades. We're going to be looking at continuation trades in depth. We're also going to be looking at reversal trades tomorrow. Reversal trades are counter to the trend. So a reversal trade, see, this is the trend, bearish. Reversal trade is counter to the trend. Reversal trades occur on support areas in a bearish trend and on resistance areas in a bullish trend. I don't think this was an actual reversal trade because I think this area was a bit higher at the time. But let's just pretend, just for an example for now. But I'll show you some actual reversal trades that were taken. I'll show you some actual reversal trades tomorrow. But just for an example, a quick example. See, the problem is this resistance area, this support area, I believe, was further up. So this one wouldn't have been taken. That's just to make that clear. But let's just pretend that this support area at the time that this bounce happened was down here, just as an example. All right. Tomorrow, I'll show you real examples. It's just easier than looking for a real example. So I'm going to show you this real quick. So this would be basically a reversal trade because it's counter to the trend. So price is trending down. So we're taking a reversal. We're trading in reverse of the trend. So this is a reversal trade. And again, it's using the same basic logic. We're using the same basic idea. Price trending down. Sellers are in control. It hits an area of support. It stalls and it turns around. But yeah, this, let's see if I can find I don't think there's many reversal trades that occurred on New Zealand USD recently, just because of how heavily it's been trending down. I think most trades have been in line with the trend. maybe this one, but on a lower time frame. You can also trade this strategy on lower time frames. You don't need to trade it on the high time frames. Yeah, okay. So here's a reversal trade on a 6-hour chart, but it's probably also on the 8-hour chart, I believe. Yeah, maybe not. Maybe the 12-hour. Let's see if it's on the 12-hour. Nah. Yeah, let's stick to the 6-hour. 6-hour is probably the best example. So, strong bearish trend. Bears in control of price. Price hits a support area. Now you might be thinking, why is this support area there? So let me show you why it's there. Just make it red so we can keep an eye on it. So back here, this area was placed based on these massive, massive bounces here. That's a bit, let's narrow that down so you can get a better view of it. So this area was placed based on these massive bounces here. So it's a strong area of support. So after quite a long time, so price broke above this area back in 2016. Price stayed above this until June 2018, at which point it came back down. When it came back down, it hit this very same area. And what happened? Sellers in control, boom, price turns around. That very same area back from 2016. Now, we would have struggled getting into a trade here on the daily because there was no indecision. But if you drop down to the 6-hour, you can see here, price goes down, stalls out on this support area. We get indecision. So we have a decidedly strong bearish trend, hits this area, turns into price stalling, turns into indecision. Get indecision, you go long. Now, the exact entry criteria we're going to discuss tomorrow. So there's a lot of things to it, so I can't go over it today. We don't have enough time today. But it would be something roughly like this. Go long here. And that's the trade. Now, I don't like showing examples of just good trades because that's kind of very dishonest. I'm trying to remember a failed trade on New Zealand USD. I should have probably wrote down some examples of trades, like looked on my trading record to get some actual trade examples. I could show you a trade that didn't outright fail. It didn't hit the stop loss, but it just kind of sucked because so this is a continuation short here. Short continuation. So price comes up to this area, stalls, and pushes down. Now, this looked like a decent trade, looked like it could have been profitable, but reality is that this one, wait, let me, there we go. So in this case, price comes up, stalls, and see, it never quite gets to the target until here. But you got to remember, this is a daily chart. So this is 29 days. This is a month before it hit target. You would have been out of that trade by that point. Generally speaking, I don't hold trades for a month waiting for them to hit target. So that trade would not be closed with its full target. Well, what are you talking about? Where's the failed trade? Which example? This? Yeah, you probably wouldn't have entered this one. Or maybe you would have. It depends where this area was at the time. Maybe you would have entered this one. There's a possibility you would have entered this one. But this isn't a good failed example because actually, no, I was wrong. I was going to say you wouldn't have entered this one because the risk to reward ratio would be too low. We have a limit of 2 for our risk to reward ratio. So your risk to reward ratio has to be at least 2. That means your target's 2 times the size of your stop loss. When I saw this candle, I thought it was way too big to give us a 1 to 2 risk reward ratio, but I was wrong. It's actually a 1 to 2 risk reward ratio. So this is in fact a failed trade. My bad. So yeah, this one is an example of a failed trade. Thanks for pointing that one out. See, price drops down. This is a counter trend trade. Comes up, but it never gets anywhere close to target. Goes down and hits the stop loss. Counter trend trades are always riskier. It's less risky trading with the trend, but counter trend trades, as you've seen, can be profitable. So it's fine trading counter trend. You just got to accept that overall it is slightly riskier. But yeah, that is the basics that we're going to cover today. I wanted to look at support, resistance, and candlestick analysis. Tomorrow we're going to look at how to put these things together and how to actually properly spot and enter these trades. Right now I've just given you an example of what the trades look like, but we're going to talk about actually spotting and entering those trades. We're going to look at a lot of failed trade examples tomorrow. I'm going to go through a lot of failed trade examples. I'm going to go through a lot of good trade examples, and I'm going to go through a lot of mediocre trades as examples. I want to cover everything, every aspect of the strategy. No strategy has a 100% success rate. Most strategies in Forex have 50 to 60, 65% sometimes success rate, depending on the trader also. Some traders get more out of a strategy than other traders, based on experience, essentially. A lot of people think that strategies in trading can sometimes have 80% success rates, and that is technically possible, but it's generally speaking not optimal, because to get such a high success rate, you tend to have to exit trades early instead of letting them run. When you let trades run, you usually have a lower success rate, but you make more profit in the end. But anyway, guys, let's do some quick Q&A. Giovanni. Why are bodies more important? Essentially is the question. Oh, damn it. There we go. So why are bodies more important? Because bodies are where price consolidates. Wicks are where where the extremes are. So if we place this base at the wicks, like here, then you might have missed this trade. But in my opinion, the wicks aren't as important. What's important is where price consolidates. Price consolidates at the bodies of the candles. This is where price is consolidating. This is where price is stalling. So placing them there allows you to spot when price is stalling at support resistance. Placing them at the extremes, like here, isn't really as important because price doesn't often hit the extremes. Price usually, when it's approaching an area of support, it stalls where the congestion is, where price consolidates, where it consolidated previously. So if you really want to, you can play support resistance at the wicks. Just keep in mind that when price is next to the point where price stalled before, that's also going to give you a valid trade. Matthias, I'm not sure how to say your name. I use daily charts for placing support resistance, but I take the trades on all time frames. We'll get more into how to take trades tomorrow. Abdul, do you suggest any particular distance between two support resistance areas? No. Depends on the chart. Some support resistance areas are very close together. Some aren't. It depends on the chart. Depends. When I say on the chart, it depends on the pair. Some pairs are closer together. Just place them at the obvious bounces. Do I trade hammers too or only dojis? I don't trade only dojis. I don't trade only hammers. I trade indecision. So that can be any form of candle that's stalling out on support resistance. It doesn't really matter the shape or the look of the candle. I read the story of price, not the shape of the candle. For New Zealand USD, I do not see a support resistance line at 73.90. So up here. Well, yeah, it's not relevant at the moment. There is support resistance up there, definitely, but why do I care about support resistance up here when price is down here right now? Like, there's literally no reason for me to even be bothered to place areas up here. I'll place areas up there when price turns around and starts getting close to there. When price is here, then I'll start worrying about support resistance up there. But price is here. So who cares about what's up there? That's like saying, like, price is down here. Let's place some support resistance areas up here. When are those going to be useful? 2 years, 3 years from now? No point. So many questions. I'm finding it hard to keep up. Do you ever move your stop loss to break even? Yeah, we'll talk about that tomorrow. Do you look for indecision when entering continuation? I already showed you examples of looking for indecision when entering continuations. That's a continuation. That's a continuation. That's a continuation. That's a continuation. They all have indecision. Does support resistance ever become invalid? Yes, definitely. You have to adjust them. How often do you adjust SR? That's a good question. I adjust them pretty much every day. It's not like I make a point of adjusting them. I don't say, okay, this is my support resistance adjustment time, and start adjusting them. That's not how I do it. I just look at my chart. If I see anything that's off, I'll move it. I'll adjust it. I'll push it up. I'll push it down. I'll change it. Like, for example, this area was up here. Then that bounce happened, and I was like, okay, let's move this one down here, because it makes more sense to have it there now, because that's a more recent bounce. Raphael, what's the maximum time optimum to let a trade run if it doesn't hit your TP yet? That's, in fact, a very, very good question. But that is also something that's very advanced. And it depends on a lot of factors. What's your aha moment, Eli? Matthias, the scalping strategy is different, but it's also very, very similar. How do you tell the difference between a pullback and a trend reversal? You don't really tell the difference. It doesn't really matter. You can trade both. Both are going to be fine to trade. Nikesh, I already answered that. Daily chart. Eli, you felt like if you move your support resistance areas, you would screw things up. No, I adjust them all the time. Literally, almost every day, I'll pull one up or down just to adjust it to the most recent data. Will I be advising on charting software and brokers? There's a whole free course on my website. It's completely free that I advise on how to find a good broker. Do I use weekly or monthly charts? Nope. Do I adjust my stop loss during high impact news or stop hunts? Stop hunts aren't really real. Well, I don't know, maybe. I guess it depends what you mean by stop hunts. Certain kinds of stop hunts are real, but I get a feeling you're talking about something that's not real. But anyway, high impact news, do I adjust my stop loss? Yeah, I'll either tighten or widen my stop loss. It depends on a lot of factors. Yeah, a lot of trading comes down. A lot of people are unhappy when I answer a question because I say it depends on a lot of factors. I do different things in different scenarios, but that's the reality of trading. There's no one size fits all in trading. When you're in a trade and high impact news is coming out, sometimes you want to make your stop loss wider to give it a bit of breathing room. Sometimes you want to make your stop loss tighter. It just depends on a lot of factors. And how do you learn this stuff? A lot of it is just an experience thing. It comes with experience. A lot of it is stuff you can learn, but it takes time. What's my minimum risk to reward ratio for a quick reversal trade against the dominant trend? That's a good question, man. Generally speaking, my minimum risk to reward ratio is 1.5. But if I'm going for 1.5, I want to see at the next resistance area. Let me show you an example. I'll show you an example based on that failed trade that we were looking at. So this failed trade here. I like to see a minimum of 1 to 2 at the next resistance area. So let's say we're going long. The next resistance area, I want it to be at least 1 to 2 R away, which it was in this case. But my actual first target, my primary target, is 1.5 risk reward ratio on a counter trend reversal. However, I almost always try to extend that target up to that 2. That's why I like to have at least 1 to 2 at the next resistance area. But my initial target's 1 to 5, and then I'll extend that if I can. You missed everything, Jerobi. You're like an hour and 15 minutes late. Sandra, exactly. Trading's not black and white. You always have to consider a lot of things. It's like any complicated thing in life. People want to boil it down to something that's super simple and super easy, and there's just like a question A, or the answer is always B. 1 + 1 = 2 always, but that's not how trading works. It's like anything that's complex in life. Any complex job or activity. You can't boil it down to a simple step 1, step 2 process. Do I use Elliott wave analysis? Nope. Some of my students use Elliott wave in conjunction with this, and they have good results. I just never really found a use for it personally. Oh, there you go. George answered that question. Do I add on lots if a trade moves in my favor? No. In trading, 1 + 1 = 3 sometimes, yeah, definitely. Trading is tough. It's like, you know, when you enter a trade, there's so many little things to consider. And it's so easy to make a mistake. And there's almost never an answer that makes sense in every single scenario. Every scenario is different. How often do you get trades? It appears you have to wait for days to get near SR. Yeah, but there's a lot of pairs. I'm just showing you one pair at the moment. There's a lot of pairs. And also, we're also trading the 30-minute and the 1-hour chart, although we're not talking about that in this webinar, so. Trend lines are support and trend lines are a form of price action, and they can be used. I just don't really like trend lines because I find them a bit arbitrary. So I personally don't use them. Forex Hangout. I won't be talking about emotions. I can only fit so much into a webinar. These two webinars are about strategy. I'll be doing psychology webinars in coming months. Thoughts on the US dollar index? I don't really find much use on it. I've tried using the US dollar index a few times, but I find that it mostly just keeps me out of trades that I would have entered anyway. Because I'll be like, oh, the US dollar looks really strong, so I'm not going to short USD CAD. And then shorting USD CAD would have been a great move, and the dollar index kept me out of the trade. So I just find that it clouds my my analysis or my judgment, so I don't use it. Do you use negative correlation pairs in your analysis? I'm not sure what you mean by that. I know what negative correlation is, but I don't quite get what you mean by do I use negative correlation pairs in my analysis? Like if I spot a trade on USD CAD that's bullish and a trade on GBP USD that's bearish, do I count that as a higher value setup because the negative correlation is because of the negative correlation between those two pairs and them giving me opposing setups? Do I count that as higher value? Is that what you mean? I ignore like most news, Raphael. Patrick, yeah, the answer to that is yes. It's a factor in my analysis. If I see things that are negatively correlated and they have opposing setups, then I'll be like, okay, this is a better sign. If someone held me at gunpoint and forced me to add a single indicator to my strategy, which one would I choose? I think my first question would be, why is this so important to you that you need a gun? Actually, maybe if someone was pointing a gun at me, I probably wouldn't be a smartass. But it's an easy answer, though. It's one that I already have on my strategy. It's for some advanced trade setups that I do, and it's the 200 moving average. It's technically an indicator. I don't use it as an indicator, though. I use it as support resistance. Basically, this 200 moving average is just a support resistance area. It's a moving support resistance area. Self-adjusting. the reason it works is because, like other support resistance areas, banks and hedge funds use these use this 200 moving average as support resistance. So it acts as support resistance. So yeah. But I'm not teaching the use of this at the moment because also the zigzag indicator. I'm testing the zigzag indicator as an automated support resistance placing tool based on someone on the forum suggesting it. But, oops, doesn't seem to work that well. You have to mess around with it a little bit. See, kind of like this. Zigzag indicator. It basically just bounces around at where your support resistance would be, sort of. See how it lines up with them? Doesn't work this perfectly on all pairs though. So I'm going to probably get someone, a programmer, because I looked into the code myself, but it's a bit too complex for me, to instead of having these zigzag lines, to just have it place support resistance at these points. So yeah, that one's somewhat interesting. But you can see it doesn't always work perfectly. Like on USD CAD, for example. It's interesting. You put it very dim. Yeah. Oh, you can't put it dim here. Well, I guess you can. Oh, yeah, you can. You can put it transparent there. Yeah. If you had to place two zones really close together, would it be a good idea to place one? Generally speaking, no. If there's two support resistance areas very close together, I'll give you an example of one, actually, that's happening right now. It's on EuroJPY. There's two support resistance areas that are super close together on EuroJPY. Where is EuroJPY? These two here. These two support resistance areas are very close together. Now, a lot of people, they say, all right, let's just place one. Or they go the other way and they say, well, I'm just going to pretend this one doesn't exist. But neither of those is a smart idea, because you pretending it doesn't exist doesn't mean it doesn't exist. Price is still going to stall from that area. It's going to stall from both those areas. So you just place it and you say, all right, this area is too messy. I'm not going to trade in this area. Support resistance too close together. I'm not going to trade in that area. Sean, didn't you ask me that question via email? I'm pretty sure I responded to you via email. Or maybe it wasn't you. But someone asked me this exact question yesterday. You have to move the line and then the shaded box, but you don't have to do that. When you place a parallel channel on TradingView, you go to the settings and you click middle. And then that adds a center line. See, if it's not there, once you select middle, then the center line appears. So these aren't two separate lines. This is just a single entity. All right, sorry. Someone asked me that exact question yesterday. I thought it was you. Yeah, Eli, I do agree with you overall on that zigzag thing. But I think there might be some value in having an indicator that places support resistance areas based on the zigzag, and then you could just shift them around a little bit to perfect them. It's probably not going to happen. I'm going to look for a programmer to do it just because why not? I use the parallel channel, Rick. Parallel channel tool. You find it here. Let me move the chart. Find it here, parallel channel. Once you get it, you go like that, and then when you first place a parallel channel, I can't remember exactly. Oh my god, what the hell is it doing? I think it'll look something like this. It looks something like this. So you double click it after you place the first one. Click extend left, extend right to extend it. Click background to give it a background color. You click middle to add a middle line if you want it. You don't have to have it. And then you change the color of the channel to whatever you want. And then you can change the thickness and all that stuff, all the settings there. You do what you want with that. And then they become cool support resistance areas. Is it a good idea to give yourself time limits? Yeah, definitely, man. If you're new to trading and you're struggling, give yourself some time limits. Definitely. 100%. Good idea. Check your charts every few hours. Because if you're like staring at your charts all the time, you're going to freak out and you're going to make stupid decisions and exit trades early or exit trades or widen your stop loss, or you're just going to make dumb mistakes. Everyone does it. I am guilty of it still to this day. I will sometimes make stupid decisions just because I stare at a trade too long and it clouds my judgment. I obviously don't do it as much as a new trader would, not even nearly as much, but I've been trading for like almost 2 decades. So I've kind of got this thing figured out. But if you're new, if you think about it this way, I still do that sometimes. I'll make stupid decisions if I stare at a chart too much. And I've been trading 17 years. If you've been trading less than a year, you're going to do that a lot more. Obviously. It's just logical. So, set some time limits. Do what you need to do. Do I have a particular time of day to trade? No, I just trade when the setups come. Do I check any site or forum to gauge market sentiment? No, that is completely and utterly useless in Forex. Who cares? Literally, who cares what 10,000 retail traders are thinking? Why does that matter? In a market that several trillion dollar market, retail traders make up almost nothing in terms of what moves the market. Almost nothing. All the retail traders on the planet could take a trade in the same direction and it would have almost no impact. So who cares what they think? There's an actual assessment every 3 years or every 5 years. I think it's every 5 years. It looks at the percentage of retail traders, the percentage of retail traders in the Forex market. What percentage of the several trillion do they make up? And it's under 10%. I think it's under 5%. I can't remember the exact number, but it's very low. So even if 5% of the entire market agrees on one thing, the effect is going to be minimal. And on a single website like Forex Factory, where you can look at market sentiment, you're not seeing what 5% of the entire market is thinking. You're seeing what 5% of the 5% of retail traders are thinking, or maybe 1% of the 5% of retail traders. So you're looking at what 0.005% of the market is thinking. Who cares? They have no impact. And half of them aren't even trading the Forex market. Half of them are trading with market maker brokers who essentially are making their own market and have, not all of them are actually putting trades through to the actual market. So again, they have even less impact. Exactly, Giovanni. Volume is useless in Forex. In the stock market, volume is very, very important, but that's because in the stock market, there is a central exchange, the New York Stock Exchange. All the orders flow through the New York Stock Exchange, so the volume data is very important. But in Forex, it is useless because there's no central exchange in Forex. Raphael, yeah, I do trade from my phone. Could your method be applied to other markets? Yes, I trade futures. I'm looking into options at the moment because options are awesome. You don't need stop losses in options. One of my best students, some of you may know him, Viet, he started trading options recently, and then I started looking into it. Options are awesome. Probably going to be sharing some options trading stuff in the future. Options are just great. Like, no stop losses needed. It's like a game changer, really. I trade other markets using the same strategy. What is a breakup block? I got no idea.